In financial planning or financial strategies, the thing that's very important that you're educated on is to be very careful how you respond to general questions, right? Like a general question, what's the best age to get life insurance? Now, I'm not really sure what the best age is, but we can get into some information. We could get into why certain ages may be more beneficial than others. But like anything else, I mean, there's people in life that have careers and maybe in their 20s or 30s, the career didn't go that well, changed careers, and in the 30s and 40s, they began to excel at a whole nother level. Well, it's the same thing with insurance. Yes, when you get older, there may be a different version of that insurance based on the death benefit, but that doesn't mean the other parts of it aren't more powerful. So this question popped up because you folks out there are looking for it, and we're going to provide education, no doubt about it. But at the end of the day, don't make decisions based on general, either definitions, answers to general questions. The key to any kind of success, intentionality, and be very specific. Even when you write goals, you want to be specific. Hey, I want to make $1 million. Great. Why do you want to make $1 million? What's going to give you leverage every day to make that $1 million? How are you going to show up every day? Is the money to buy a boxing promotional company in Mercedes-Benz like I did back in 2008? Or is it to really help humanity take another step forward? Is it to help people eat? Is it to provide education? Is it to take some of that $1 million and put $250,000 into your social media world so you could put education out there for people because you, meaning me, grew up in a blue-collar world where we didn't understand money? And how does that tie into what's the best age to get life insurance? It's all about education. All right, listen, folks, we're going to do a little bit of reading again, right? But here's the key. When it comes to the world of, let's call it creating your own wealth, being able to become your own entrepreneur, I don't like to live in a place of needs. I want to live in a place of wants. I don't want to meet needs. I want to exceed wants. But once again, I'm playing in the rules. This is the rules of the insurance. Now, I'm specifically showing you how insurance's marketing material comes out, right? And they're going to say 3 reasons to buy young. 3 reasons to buy young. Here's a quick little snippet here. Everyone has different monetary and life insurance needs. What they're basically saying is, what is the need? Well, if the spouse that makes all the money shuffles off this mortal coil, how much money is needed, right? When we plan, we want to make sure that not only do we meet the needs, but exceed the wants. We don't want to just pay off the mortgage. We want to still maintain that generational wealth that's being built, including what the family investment philosophy was. Here's some benefits to getting, 3 of them in particular, according to them. 3 benefits of getting your policy earlier rather than later. And let me be clear, this is not what I'm saying, this is what they're saying. You know, thank you so much for really looking into this, because this is a question that a lot of people are asking, and I'm encouraging you folks out there to ask a different question, okay? Because at the end of the day, yeah, listen, if you buy insurance earlier, does it have more benefits later on long term? It does. If you buy it situationally versus earlier, can you still experience similar benefits? You can. So this isn't about simply buying it at an early age. But if you kind of look at how the information is really kind of given out, it's basically, you know, one of the main factors is, do other people depend on your income? Now look, if you're young, if you're 21, 25 years old, I don't really know who's dependent on your income, right? I mean, let's just call a spade a spade. So let's make sure this video is congruent, but we truly understand what the messaging is, right? So I don't think anyone depends on your income if you're young, unless you're already running a business that's phenomenal, unless you're married with kids, no doubt about it, then they do. So let's talk about the 25, 35, 45, or a 55-year-old that has children or has people that are depending on them. Generally speaking, dependents are one of the main reasons people purchase life insurance. And in that scenario, they probably purchased the wrong kind of life insurance, meaning you're going to hear or see about people that buy term insurance. I'm not saying term is bad. I'm not. What I am saying is, if you have an investment philosophy, if you have a purpose and understand what your goals and intentions and really objections are, right? And really what your objectives are. If you understand what that is, what's going to happen is you're not going to just buy term. You may blend it in, But at the end of the day, you're going to purchase the right kind of insurance because that's going to allow you to never, ever have your death benefit expire like it would on a term policy. And when we look at number 2, the sooner you purchase life insurance, the better. With each passing year, you could run the risk of becoming uninsurable. Now, that's a great point because they'll tell you the sooner you buy it, the better because it's cheaper, right? The cost of insurance comes into that conversation. And I'm not saying it's not true, but it's kind of like the difference between average rate of return and the real rate of return. If you have any questions on that, go ahead and ask below and I'll tell you privately. But at the end of the day, the risk is you could become insurable. So what a lot of people did in the 80s and 90s, Al Williams came out with a nursery rhyme, which was buy term and invest the difference. And he made a lot of money with that process, as did the financial institutions, because people put the difference into 401ks. Oh, by the way, for any fiduciary out there, I'm not a fiduciary. I do have this question, if you could add it below and give me some reasoning behind it. If you're managing qualified money, and the client's paying a fee on that qualified money, are you backing out what they're going to have to pay in taxes later on? For example, if there's $1 million 401k, is your fee based on $700,000 or is it based on the $1 million, even though they're going to get taxed on it? That's another conversation for another day. So when we look at the risk of uninsurability, I think of the folks that bought term, invested the difference, got to retirement, their term policy lapsed, or the time frame was done either 20 or 30 years. Now they can't buy insurance. For some reason, they have some heart issues. Maybe they're overweight. For whatever reason, you get into the late 50s and 60s, which is never too late to buy insurance, but they don't qualify medically, which now means their $2-3 million 401k, they got to be very careful not to outlive that money. And while that's happening, they also got to keep an eye on what the taxes are going to be within that money. But at the end of the day, when it comes to the risk of buying it later on versus early, it really comes down to insurability. So look, everyone knows that, listen, if you watch my videos, I love cash value life insurance. Do I say put every dollar you have into cash value life insurance? No. Do I say put money into a savings account for an emergency fund? Yes. Am I a fiduciary? Not at all. Do we have a relationship with a team of fiduciaries? The answer is absolutely yes. Do I believe that if the right hand is speaking to the left hand, if the accountant is speaking to the fiduciary, trust officer, insurance agent, will you be better off? I challenge you right now to tell me that you wouldn't be, okay? At the end of the day, if these people aren't talking to each other for your benefit, you're already losing out on the game in the long term. That's just my opinion, though. So with that being said and done, cash value life insurance, right? We have permanent life insurance, has a cash value component. Holding the policy for longer lets the cash value grow over time. But this is what no one talks about. Overfund the policy early. For all you insurance agents out there, make less money. Don't do the traditional L20 or L65 or L100 or L95. Do it where they could build up cash value earlier so the folks out there have more decisions to utilize their money in a different fashion while they're in the wealth accumulation phase. So the point is, cash value life insurance, and oh, by the way, for all the IUL folks out there, listen, don't get mad at me. I understand that since the first IUL product came out, I want to say in 1997, and it's tied to the S&P 500, and there's a good story there. But remember, when you leverage it, and that money you're leveraging doesn't get interest credit, and when you're looking at the ability to maybe complement it with this kind of policy, I think that's a good idea. But I'm not going to say that in general terms. I'm going to say that specific to a client that has a certain objective. So in our business, there's a lot of graffiti. There's a lot of marketing, and there's definitions, and Investopedia basically says when it comes to life itself, buying life insurance, younger is better. Okay, wow, like that's just such a general thing. What do you mean younger is better? I don't even understand what that means other than, okay, you maybe get a bigger death benefit because you're a lot younger, but what does your cash value look like? What does your dividends look like? I guess you're going to say, listen, if a 20-year-old buys it and goes out to age 100, it's going to look so much better. I understand that. But for anyone out there that's not younger and you're doing your research, don't listen to this definition, because this doesn't identify who you may be. You could be a business owner. You could have multiple children. You could have multiple businesses. And life insurance not only is for the dependents in a family, but if you own a business, There's also key man, key woman. There's also Section 162 double bonus plans. There's all these different things that keeps the business financially fluid. God forbid if you shuffle off this mortal coil. But once again, I'm answering questions that are out there, and I'm giving definitions according to the authorities in these kind of definitions, and this is what they're saying, and I totally disagree, just so we're on the same page. What I do agree with is if you're younger and you understand who you are, what your goals and objectives are, what your investment philosophy is, will you be better off than someone that discovers this when they're 40, 50, or 60? The answer is yes. So look, check it out. Here's the thing. And I want you to ask yourself a question. Does your accountant talk to your fiduciary? Does your fiduciary talk to your trust officer? Does your trust officer talk to your insurance agent or mortgage broker? Is there communication fluidly going on between the financial professionals in your world? Or did you happen to buy a bunch of different products from a bunch of different people at different points of your life based on a bunch of different opinions and have created what they call a junk drawer of financial planning? And by the way, this doesn't make you bad. It makes you like everybody else. If that's the case, and you truly want to be able to get financial homeostasis, meaning balance, go ahead, click the link below, schedule a consultation call. One of the team members will get back to you, share with you our success process only after we understand what your investment philosophy is and what your goals and objectives are. Looking forward to hearing from you, and thank you so much for checking in our channel. Hey, listen, thank you so much for watching. Go ahead and hit that subscribe button and ring that bell. And by the way, check out this video over here.